Life insurance exists to protect the people and obligations you would leave behind if you were gone tomorrow. At its core, it operates as a contract. You make regular premium payments to an insurance company, and in return, that company agrees to pay out a sum of money, known as the death benefit, to the people you designate if you pass away while the policy is in effect. That money can serve as a financial lifeline, giving your family breathing room to keep up with expenses, avoid making rushed decisions about assets, and hold things together during a time that is already incredibly hard. The reason this coverage matters is straightforward. Most households run on income, not accumulated wealth. A mortgage, monthly utility bills, groceries, childcare costs, health coverage, car payments, and school expenses don't disappear when a primary earner dies. Even in a two-income household, losing one salary can create a serious shortfall. Life insurance is built to address exactly that problem. It can also clear outstanding debt so your family isn't left managing a heavy financial load on top of grief. It can fund long-term goals like a child's education, help keep a family home from being sold, or provide ongoing support to parents who depend on you. In certain situations, it plays a role in business planning too, allowing partners to purchase a deceased owner's share or keeping a company financially stable after the death of someone the operation relied on heavily. The majority of life insurance products fall into one of two categories: term life and permanent life. Term life insurance provides coverage for a specific window of time, commonly 10, 20, or 30 years. It's the more straightforward of the two options. If you die within that window, the people you named receive the payout. If you live past it, the coverage expires unless you take steps to extend or renew it. Term policies tend to appeal to people because they can deliver a significant level of protection at a cost that is manageable, particularly for younger and healthier applicants. They're often a practical match for the years when financial exposure is at its peak, raising a family, paying off a home loan, or building up savings for retirement. Permanent life insurance is structured to remain in place for your entire lifetime, as long as premiums continue to be paid and the policy doesn't lapse. Beyond the death benefit, permanent policies generally include a cash value element that can grow over time. Different varieties of permanent insurance work differently under the hood, but the core principle is that a portion of your premium covers the cost of the insurance itself, while another portion may build up as accessible value within the policy. The trade-off is expense and complexity. Permanent coverage typically costs considerably more than a term policy offering the same death benefit, and it introduces more variables, fees, projections, and financial penalties for canceling early. It can be the right tool for specific long-term situations, but the higher price tag and added complexity don't automatically make it the superior option. Choosing what type of coverage fits your situation starts with being clear about what you're actually trying to accomplish. If the objective is to replace a lost income and cover financial obligations during your working years, term coverage tends to align naturally with that goal because it mirrors the period when your financial responsibilities are greatest. If you have a dependent who will need support indefinitely, a specialized estate planning need, or a business arrangement that requires lifelong protection, permanent coverage may deserve a serious look. The right fit depends less on what a product is called and more on the specific outcome you need it to deliver. The coverage amount is one of the most important decisions you'll face. A common mistake is underestimating by looking only at current monthly expenses rather than thinking through the long-term picture. A more grounded approach is to think about outcomes. If you were gone, what would you want your family to be capable of doing? Staying in their home, eliminating specific debts, maintaining childcare arrangements, keeping retirement savings on track, covering future tuition costs, or having enough of a buffer that a surviving partner could take meaningful time before rushing back to work. Working from that picture, you can build toward a number that supports those outcomes. Some people target a set multiple of their annual income. Others map out a more granular breakdown that accounts for debt elimination, ongoing household costs, and specific future goals. The aim isn't a mathematically precise figure. It's a coverage level that would genuinely make a difference without putting too much strain on your monthly cash flow. Understanding how premiums are determined takes some of the mystery out of the process. Life. Insurance pricing reflects risk and time horizon. With term coverage, the insurer is essentially calculating the likelihood of having to pay out during a defined period. With permanent coverage, the company is committing to a much longer relationship and often providing features like cash value growth, all of which drives the price up. Age is one of the biggest variables because the statistical likelihood of dying increases as people get older. Medical history plays a significant role as well. Factors like blood pressure readings, cholesterol levels, prescription medications, and family health patterns all feed into the assessment. Behavioral factors like tobacco use can push premiums considerably higher. Certain jobs and recreational activities can also influence pricing when they carry elevated risk. One practical takeaway is that securing coverage while you're healthy tends to lock in a more favorable rate and protects your ability to get coverage at all if your health situation shifts later. The application and approval process, or called underwriting, involves answering detailed questions about your health, daily habits, and financial picture. Most policies require a medical exam that typically includes basic physical measurements and lab work. Some carriers offer policies that skip the exam for eligible applicants and certain coverage levels, though the pricing and available limits vary. Underwriting may feel like an intrusive process, but it exists to keep rates appropriately calibrated across all applicants rather than forcing everyone into a single, blended price. There are also some legal and administrative aspects of life insurance that are easy to overlook, but genuinely important. Beneficiaries are the individuals or entities designated to receive the payout. Standard practice is to name both a primary beneficiary and one or more contingent beneficiaries. A backup layer so the money still reaches the right destination if the primary recipient is unable to collect it. Revisiting these designations after significant life events, getting married, going through a divorce, welcoming a child, or losing a loved one, is one of the more important maintenance tasks that often gets skipped. Naming a minor child directly as a beneficiary can also create legal complications in many states, which is why families sometimes establish a trust or similar structure to manage those funds responsibly until the child is old enough to receive them. Something many people don't anticipate is that life insurance policies have a built-in review window for early claims. This is called the contestability period, and it typically covers the first 2 years the policy is active. During that window, if the insured person dies, the insurer has the right to review the original application for accuracy before paying the claim. This isn't a mechanism to avoid paying out legitimate claims. It's a safeguard against deliberate fraud. The straightforward way to avoid any issues here is to complete the application honestly and thoroughly, even when certain disclosures feel uncomfortable. Inaccuracies, depending on how significant they are, can result in delayed payments, reduced payouts, or outright denial. Permanent policies layer on additional decisions that require real attention. If you're seriously considering one, it's worth digging into how the cash value component actually accumulates, what charges are built into the policy, what assumptions drive the projections in any illustrations you're shown, and what happens to the policy if you draw on that cash value. Many permanent policies allow you to take loans against the accumulated value, but any outstanding balance reduces what gets paid to your beneficiaries. And if the loan grows unchecked, the policy can eventually collapse. that outcome can carry tax consequences in some circumstances. None of this makes permanent life insurance a bad product. It means it rewards owners who stay informed and engaged rather than treating it as something to file away and forget. Taxes are a point of confusion worth addressing clearly. In the vast majority of cases, the money paid to beneficiaries from a life insurance policy is not subject to income tax. That tax advantage is a significant part of what makes life insurance such an efficient protection vehicle. There are edge cases and nuances, particularly around very large estates, certain ownership structures, and more advanced planning strategies. But for most people, buying straightforward coverage to protect their families, the focus belongs on finding a policy that is affordable, reliable, and sized appropriately for what they need. A few recurring mistakes are worth naming directly. One is choosing a coverage amount that's too small, typically because someone only thought about immediate debt and ignored the longer runway of income their family would lose. Another is committing to premiums that stretch the budget too thin, creating the risk that the policy eventually lapses right when it might be needed. A third is approaching life insurance primarily as a wealth-building tool rather than a protection mechanism. It can absolutely fit within a larger financial strategy, but its core job is to deliver a reliable outcome when the unexpected happens. And perhaps the most common oversight of all is reviewing the policy once and then never revisiting it. Coverage needs evolve. A new child, a larger home, a business venture, or a jump in income can all mean the policy you bought 5 years ago no longer fits your actual situation. Life insurance is fundamentally about having a say in something you can't fully predict. You can't determine how long you'll live. What you can determine is whether the people who depend on you would have the financial foundation to move forward if you weren't there. A thoughtfully chosen policy is one you can sustain over time, one that spans the years when your absence would create the greatest financial strain, and one that pays out enough to provide genuine security rather than just a symbolic gesture. If you want, share your age range, whether you have dependents, and whether your main priority is covering a mortgage or replacing lost income. And I can walk through a practical framework for estimating the right coverage amount and term length for where you are right now.